Today we'll examine practical applications of the trend channels with liquidity breaks indicator by Chart Prime. We'll explore effective methods for trading both breakouts and ranges using this tool, complemented by an additional indicator for precise entry identification, along with optimization tips. Let's dive in. But before we begin, let's refresh our memory on what the trend channels with liquidity breaks indicator is about. The trend channels with liquidity breaks indicator, created by Chart Prime, identifies and visualizes trend channels in price action while highlighting potential liquidity breakpoints. It works by detecting pivot highs and lows, calculating their slopes, and creating channels with top, center, and bottom lines. When price breaks beyond these channels, the indicator marks these points as potential liquidity breaks, showing whether high or low liquidity was present during the break. The indicator offers customization options including channel length, visibility of the last channel, break confirmation weighting, line extension, and volume background coloring. Color schemes differentiate between upper, middle, and lower channel zones, with visual intensity reflecting volume activity. Primarily beneficial for trend-following traders, this indicator helps identify potential continuations or reversals. When price respects channel boundaries, traders might consider entering positions in the direction of the established trend. Conversely, breaks above or below channels can signal potential trend changes or liquidity grabs. When markets consolidate between defined boundaries, you can look for potential entries by simply watching for price rejection at channel lines. Or you can use the Engulfing Candles Detector by Dave Ott for additional confirmation. The Engulfing Candles Detector identifies specific candlestick patterns that can serve as confirmation signals. A bullish engulfing pattern, marked in blue, occurs when a bullish candle's body completely engulfs the previous bearish candle's body. Conversely, a bearish engulfing pattern, marked in purple, occurs when a bearish candle's body completely engulfs the previous bullish candle's body. These patterns often signal potential reversals or continuation points, making them valuable for timing entries when combined with channel analysis. If you want a complete trading system with full customization so you don't have to jump between tools, Quantum Ribbon Pro was built for that. Link in the description. Let's continue. The combination of trend channels and engulfing candles creates high-probability trading opportunities. For this approach, set the channel length to 20. This is just one of the workable options, so feel free to experiment. For long positions, wait for price to approach or touch the bottom channel line. Enter only when a blue bullish engulfing candle forms near this support area. This combination signals potential buying pressure at a technical support level. Place your stop loss below the low of the bullish engulfing candle, or slightly below the channel bottom with an appropriate buffer. For short positions, wait for price to approach or touch the top channel line. Enter when a purple bearish engulfing candle forms near this resistance area. This pattern suggests selling pressure emerging at resistance. Range trading works best when price has respected channel boundaries multiple times. Verify this pattern exists by checking for at least 2 to 3 tests of both upper and lower boundaries before implementing this strategy. Also consider volume characteristics. Engulfing candles with above-average volume generally provide stronger signals. Avoid engulfing candles that form in the middle zone of the channel, as they typically offer lower probability setups. Focus on signals that appear at or very near channel boundaries. Range trading setups work best in low volatility environments, so consider avoiding trades during major news announcements or economic releases. Breakout trading aims to capture momentum when price moves decisively beyond established trend channels. For this approach, maintain the channel length setting at 20. The direct breakout method involves entering when price closes decisively beyond the upper or lower channel boundary. For upside breakouts, enter long when price closes above the upper channel with strong momentum and increased volume. Place stop loss below the breakout candle's low or below the middle channel line. For downside breakouts, enter short when price closes below the lower channel boundary with similar confirmation factors. Place stop loss above the breakout candle's high or above the middle channel line. In both scenarios, your target should be based on measured moves equal to the channel height. The preferred method incorporates channel retests with engulfing confirmation. After an initial breakout, wait for price to pull back to the broken channel boundary. For upside breakouts, wait for price to pull back to the upper channel, now acting as support, and enter only when a blue bullish engulfing candle forms. For downside breakouts, wait for price to pull back to the lower channel, now acting as resistance, and enter when a purple bearish engulfing candle appears. This approach offers better risk-reward profiles, as entry points are closer to stop placement while maintaining the same targets. Breakouts during major market hours tend to be more reliable, and clean channel formations produce better signals than choppy price action. After a successful breakout and initial move, price frequently pauses to form a small consolidation pattern. Apply the same engulfing candle principles to enter these continuation trades. Proper risk management remains essential for both strategies. Limit risk to 1 to 2% per trade, consider reducing position size for extended ranges, and implement time-based exits if expected moves don't develop within reasonable time frames. In our previous video, we reviewed 4 powerful TradingView indicators, with strategies for which are coming in future videos, so you probably want to make note of them.